The Federal Reserve, Papa Powell himself, has stopped at nothing to signal to the markets that they will stop at nothing to get inflation down to 2%, no matter how long it takes, no matter how deep a recession will be, no matter how many people are going to lose their jobs. They will not lose this fight against inflation, which generally speaking, investors do not like inflation because it erodes away your purchasing power of your dollars. At the same time, this has caused a lot of pain in the stock market, specifically for the NASDAQ. You're down 30% for 2022 still. And not too many years do you go down 30% in the NASDAQ. You really have to go back to '08 or the tech bubble to get to these extremely sold off levels. This has caused the up moves to be very aggressive and the subsequent down moves to feel even worse than they normally would have. And the markets are all focused on one thing: the Fed and inflation. I should say the interest rates, Fed and inflation, which all kind of go hand in hand. Now, what the markets are really fearful of right now is a recession. And why are they fearful about a recession? Well, the current S&P 500 trades at about 17 times price to earnings. That means we're not really pricing in a recession. A lot of recessionary periods in time, you can see a 10 to 12 times earnings multiple. So you're still well above where it seems logical that the markets would be pricing stocks if we were going into a recession. And that's the big question mark. The average consensus is for a slight recession or to hardly avoid a recession in 2023. And virtually all of that revolves around what the Fed is going to do with interest rates. And this upcoming catalyst this week is going to be no exception. And it might help further solidify that more rate hikes are to come and the rates might actually stay there a lot longer. And the longer rates stay there, the less borrowing you will see, the less demand that you will see from citizens going to buy products, which ultimately impacts those companies' earnings. And the stock market can trade off of fear and greed only for so long before these earnings start to actually matter. Now, let's get into what this catalyst is in this next upcoming week. And by now, I'm sure a lot of you guys are familiar with this and you've heard of this before. It is the FOMC minutes. It will come out at 2 p.m. on Wednesday. And essentially what the FOMC minutes are is a detailed record of the committee's policy setting meeting held about 2 weeks earlier. So long story short, without getting into the details too much, you're going to get a report that basically says why the Fed raised rates at what they did and kind of why, right? We're going to hear why the Fed's trying to slow down. We're going to know where the Fed kind of wants to take interest rates. You're pretty much going to have an answer for that. If it's going to be 5% or higher, you're going to know that. And based off of what Fed Bullard said last week and what other Fed members have also been echoing, it could go a lot higher than 5%. And if the FOMC minutes do indicate that that is the case, 5% is not where we're going to go. We're going to go to 6 or 7. That's where you get a 5 to 10% pullback in the markets. Now, let's specifically talk about what Fed Bullard just said. Now, it says that St. Louis Federal Reserve President James Bullard suggested on Thursday that the central bank might have to raise short-term interest rates as high as 7% to ensure that inflation goes away. Once again, Bullard and other Fed officials say that central banks cannot repeat the policy errors of the 1970s. Now, there is a lot of models out there that does say we might have to go to 7% to get inflation down. And historically speaking, it's not wrong. This is a chart of the inflation rate overlapped with the federal funds rate. The blue line is the federal funds rate. The red line is inflation. And what can you see is the overall long-standing trend of these two data sets. The blue line has to go higher than the red line in an uptrend when inflation is going up to get inflation to go down. And most of the time, it leads to a recession. Some are short, some are long, But overall, the blue line has to get above the red line. That means federal funds rate has to go higher than the rate of inflation. The only thing that makes this time a little bit different is there was a lot of money printing, and the average citizen is doing a little bit better than they were, say, before 2008 or before the COVID crash, really in any time in history. Now, exactly why this is so important is because the markets are only expecting the federal funds rate to go to about 5% to 5.25% by the end of 2023. We went from expecting 3 rate hikes in total for 2022, and then we started to expect more and more, and they started to get bigger and bigger. And that's where the market's head is at, right? When you hear 5%, we're automatically kind of expecting 5.5%. But this FOMC minutes data on Wednesday at 2 p.m. could say the federal funds rate has to go a lot higher than expectations. And when expectations are wrong, I mean, you got credit spreads that are wrong. You got big money that would be wrong on this. And when that happens, that's where you get the major downside and a repricing of assets. Because if you expect the federal funds rate to go in between 6 and 7% after over a decade of low interest rates, and it's happening in a very short amount of time, that most certainly means a recession. And it's not like we're oblivious to this. The average consensus, like I said, is we will either get a mild recession or narrowly miss a recession in 2023. And there's clear signs of this. You have the 2 and 10-year bond curve, bond yield, the inverted yield curve, as a lot of people call it, at its lowest levels in all of recorded time for the yield curve, for the 2 and 10 yield curve. So it's telling you there's going to be a recession, but markets are not pricing that in. Earnings and valuations have not priced that in. So that's where the big upset comes from this week, and how you could really get a 5 to 10% up or down move in the markets. And the up move would come in form of, we didn't get any new information from the FOMC minutes. No information tends to be good news for the stock market in 2022, for a good reason, because 2022 has been pretty much nothing but bad news. So there's your potential upside. Your downside is, we know the federal funds rate would have to go a lot higher. And it's hard to say what's going to happen, but based off of what Fed speakers have said and what Fed Jerome Powell said at the last FOMC statement, that's kind of where you have to be leaning at this point. You don't want to be too long, especially with risky assets and options heading into the FOMC minutes on Wednesday. And here's this article. It says the Fed minutes may deliver a massive blow to the stock market. It says the bond and currency markets are already preparing for very hawkish minutes. Fed board members appear to think rates may head towards 5%. And when you are getting hawkish titles to articles like this, and we're only expecting 5% after Bullard just said as high as 7%, that's where you get the mismatch here. And hopefully you guys can tell where the mismatch is. Rates might have to go a lot higher, and historically they are going to have to go a lot higher. The question is the Fed going to give us that information this week or not? Do they really want to push the stock market down this week? And I think they do. They've literally talked down the markets almost every time a Fed member has spoken, and I don't think Wednesday will be any different. At the same time as this, really 2022 has been dominated by bond yields. And if the Fed does indicate that they will continue to raise rates super aggressive, that means the 10-year bonds, the 20-year bonds, basically all bonds, the yields will go up. Investors will sell those bonds. And especially after you have seen the bond yields drop from about 4.25% on the 10-year bond down to 3.81% on the 10-year bond, there's a decent amount of room to go back to the upside and to see yields go higher. And that is obviously a negative thing for the stock market. As you can see from this actual chart, when this chart drops, that means bond yields are going higher. And 2022 started right around here. So you can see it's been pretty much straight down for TLT. Bond yields have been pretty much straight up. So when this goes down, stock market don't like it, right? They don't like higher interest rates. When this goes up, that's where you get those bounces, those bear market bounces. And from this standpoint, it looks like there's a lot of selling. And yes, that means the markets might get a little bit jumpy on Wednesday, and that's why you probably want to subscribe to the channel and hit that like button so I can give you guys the most up-to-date information and what is actually said that will make those following days that much more important. Also, at the same time, household debt soars at the fastest pace in 15 years as credit card use surges, Fed report says, and this just came out last week as well on Tuesday. The key points says households increased debt at the fastest pace in 15 years due to hefty increases in credit card usages and mortgage balances. The credit card balance collectively rose more than 15% from the same period in 2021, the largest annual jump in more than 20 years, according to the New York Fed. The increase stems from a combination of robust consumer demand and higher prices, a Fed official said. So this is still one of those things that is very much going to catch up to the markets. Debt usually doesn't catch up to the markets overnight, but over the course of months and years, it tends to become a very big problem. And when you're increasing credit card usage by $38 billion month over month, you're probably not going to have as much money to spend on things like Christmas, on holiday spending, on really stimulating the economy. So there's all that information. As far as how hedge funds and money managers are positioning their portfolios, we could take a look at the Ortex data and see that on the S&P 500, the short interest of free float is sitting at about 14.5%. So it's not that short relative to where we have been throughout 2022. Now, if we take a look at the option activity, that's what I like to look at most with the S&P 500 and the Ortex data. And you could see that it has still been very bullish. Last week alone, you had 42,500 orders, totaling $5.68 billion, a positive order value of 73%. That is a lot of money going into bullish options. But if you look at the positioning for this week, it is very much to the put side. Out of the total open interest of all contracts held on the S&P 500 expiring November 25th, 29.47% of those contracts are calls. 70.53% are puts. So it does look like big money has been positioning for a downside move in this next upcoming week. And by the looks of things, it could be pretty big. As you can see from the bubble chart, there is a lot of options coming through, at the 350, the 360 strikes. You're at 396. That would be a substantial move to the downside. 5 to 10%, that's in the range of where a lot of these big options orders are placed, guys. So keep all of this in mind heading into this upcoming week. That is going to be the main catalyst. You do have a couple earnings, couple other smaller data points, but it's not going to hold the same weight as obviously the FOMC minutes. And you want to subscribe to the channel so we can keep you guys up to date when that information does come out. So that is going to be all for this video. Hit the like button. Like I said, subscribe to the channel. Thank you guys for watching. Most importantly, enjoy the rest of your day, and I will see you in the next one.